Here is a number that has been bothering me for a long time. Since 1980, the US stock market has increased in value by over 4,000%. I did the math on this myself, and it genuinely stopped me in my tracks. If you had put $10,000 into the market in 1980 and just left it there, you would be sitting on somewhere north of $400,000 today. And yet the median American worker earns about 12% more in real wages than they did in 1980-12, not 1,200, 12. I want you to sit with that for a second because I think about this constantly. The market went up 4,000%. My paycheck, your paycheck, the paycheck of almost everyone we know went up 12. So either the stock market has nothing to do with the actual health of the economy, which is what most politicians will quietly admit after their third drink, or the gains are going somewhere very specific, to a very specific group of people, using a very specific set of rules that you and I were never taught. For almost 40 years, I have watched us get told that a booming stock market means a booming economy. But while the market has gained trillions in value, my wages and your wages have barely budged, and the average family's net worth has struggled to recover from past recessions. If the stock market is doing so well, why aren't you and I feeling it? Today, I want to look under the hood of the stock market with you, see how it actually works, and uncover how a 1970s philosophy changed Wall Street forever and created an engine of inequality that is still running at full speed right now in 2026. If you are new here, subscribe right now because this channel is exactly the place I built for this conversation. No corporate filter, no sponsor telling me what not to say. Just me breaking down the honest mechanics of how money actually works, for you and for myself. Let's start at the very beginning, and I want to start here because I think the way most of us were introduced to the stock market was either through a boring textbook or through someone trying to sell us something. Neither of those experiences actually explains what is going on. So let me try something different. Let me tell you about a lemonade stand. Bear with me because I promise this is going somewhere that actually matters. Imagine you have a lemonade stand. It is doing well. You are making $500 a month in profit and you can see a massive opportunity to expand. You want to open 3 more locations across town. The problem is that expansion costs $10,000 and you do not have $10,000. Now I think about this and I realize you and I have 2 options here. Option 1 is you go to a bank and borrow the money. Now you owe the bank. You have to pay it back with interest regardless of whether the expansion works. The risk is entirely yours, and honestly, that keeps me up at night just thinking about it. Option 2 is you go to 10 friends and say, give me $1,000 each. In exchange, each of you will own 10% of my lemonade stand. If we make profits, you share in those profits. If we fail together. That second option is the fundamental concept behind a stock. When your friends buy a piece of your lemonade stand, they are buying shares. They are shareholders, and the profits you share with them are called dividends. You have just done in miniature exactly what every major company in America does when it goes public through what is called an initial public offering, or an IPO. Now here is the part that I think changes how you see everything. After your friends buy those shares, what if one of them needs their money back before the lemonade stand is ready to pay big dividends? They can sell their share to someone else. Maybe word has gotten around that your lemonade is exceptional and a new buyer thinks the stand is going to be worth twice as much next year. So they offer your friend $1,500 for that $1,000 share. Your friend profits. The new buyer now owns a piece of your lemonade stand. And here's what got me when I first really understood this. You didn't see a single dollar of that transaction. It happened entirely between those 2 people. That is the secondary market. That is what the stock market actually is on most days. The vast majority of stock trading that you and I hear about every single day has nothing to do with companies raising money to grow. It is people buying and selling pieces of companies from each other, betting on what those companies will be worth in the future. That distinction changed how I think about every financial news headline I read. I hope it does the same for you. Now, where does all this buying and selling actually happen? In the United States, it primarily happens on 2 exchanges, and I think knowing the difference between them matters more than most people realize. The first is the New York Stock Exchange, which started in 1792. I find it genuinely wild that this institution is older than most of the technology it now uses to operate. The NYSE has a physical trading floor in Lower Manhattan, the one you see on TV with people in colorful jackets and a giant bell. It tends to list more traditional, established companies. Think Ford, Goldman Sachs, Coca-Cola. The second exchange is the NASDAQ, which was born in 1971 and was the world's first fully electronic stock exchange. No trading floor, no colorful jackets, just computers. The Nasdaq became the home of technology companies. Apple, Microsoft, Google, Amazon, all of them list on the Nasdaq. Now imagine you and I are trying to follow thousands of individual stocks every single day. That is genuinely impossible. So financial institutions created something called an index, which is basically a way to take the entire market and compress it into one clean number that we can all react to. The two most famous indexes in the US are the S&P 500 and the Dow Jones Industrial Average. The S&P 500 tracks the 500 largest publicly traded companies in America. When you hear someone say the market was up 1.2% today, they almost certainly mean the S&P 500 moved up 1.2%. It is the closest thing we have to a report card for the entire US stock market, and it is the number I personally check most often. The Dow Jones is different. It tracks just 30 companies considered to be the most important and influential businesses in the American economy. It is more like an exclusive club than a broad measurement. When those 30 companies do well, the Dow goes up. When they struggle, it goes down. Both of these numbers get treated by the news media as definitive statements about economic health. I want to come back to why that framing is deeply misleading. But first, I want to walk you through how people actually try to make money in this market. Because the two dominant approaches are almost completely opposite from each other, and understanding both of them changed how I personally think about investing. The first approach is associated with Warren Buffett, and it is called value investing. Here is how I think about it. You study a company deeply. You understand its finances, its competitive advantages, its long-term earnings potential. Then you buy it when the price is lower than what you believe it is actually worth. You hold it for years or decades and let compounding returns do their work. Buffett's simpler advice to regular people like you and me is even more basic than that. Just buy a low-cost S&P 500 index fund every month and stop trying to outsmart the market. Over long periods of time, the market goes up. Stop overthinking it. I personally find that advice both boring and correct, which is a combination I have learned to trust. The second school of thought is associated with economist John Maynard Keynes, and honestly, the more I study it, the more it unsettles me in a way that I think should unsettle you too. Keynes argued that the stock market is not really about company values at all. It is a popularity contest. He described it as a newspaper beauty contest. Not where you pick the most beautiful face, but where you try to guess which face most other people will pick as the most beautiful. The winner is not the person with the best taste. The winner is the person who best understands crowd psychology. And when I apply that to investing, what it means is that stock prices are often driven not by what a company is actually worth, but by the most popular narrative about what people believe the company will be worth. When everyone agrees on a narrative, even a completely wrong one, prices can go to genuinely insane levels before reality shows up and ends the party. This is how bubbles happen. In the late 1990s, the narrative was that any company with a .com at the end of its name was going to be worth infinite money in the internet age. Companies with no revenue, no business model, and no plausible path to profitability were valued at billions of dollars because the story was so compelling. And then in 2000, the narrative collapsed. The .com crash wiped out 77% of the Nasdaq's value. Trillions of dollars in paper wealth evaporated because the story people had been buying was not real. I want you to keep that concept of narrative-driven pricing in your mind because we are going to need it when we get to what is happening right now in 2026. But first, I need to take you back to the 1970s, because what happened in that decade is the single most important thing I can explain to you today for understanding why the market and your paycheck have had such different experiences. In the mid-20th century, the people running America's biggest companies had a very different understanding of their job than they do today. CEOs of major corporations viewed themselves as stewards. Not just stewards of shareholder value, but stewards of their employees, their suppliers, their local communities, their bondholders, and yes, their shareholders too. The company existed in relationship with all of these groups, and the CEO felt responsible to all of them. I think about what that world looked like, and honestly, it sounds almost foreign to me now. When a major American corporation had a great year in 1955, they raised wages, they invested in their workforce. They built the factory in the same town where their employees lived and their kids went to school. The company and the community were genuinely intertwined. And then in 1970, an economist named Milton Friedman published an essay in the New York Times Magazine that would quietly change everything you and I experience as employees and citizens today. Friedman argued that this entire framework was wrong. He said a corporation has exactly one social responsibility: to use its resources and energy in activities designed to increase its profits for its shareholders. Full stop. Serving employees or communities at the expense of shareholder returns was, in Friedman's view, essentially theft from the people who actually owned the company. When I first read that argument carefully, I had to put it down and walk away for a minute, because it is a coherent argument, it has internal logic, and it has been the operating assumption of corporate America for over 50 years, which means its consequences are everywhere around us right now. One of the most powerful mechanisms for implementing this philosophy was stock-based compensation. If you want a CEO to maximize shareholder value, you pay them in shares. Now the CEO and the shareholders want exactly the same thing. The share price goes up, everyone wins together, except that is not actually what happens. What happens is that my CEO incentive and your CEO's incentive become tied not to long-term company health, but to short-term share price performance. And there are ways to make a share price go up in the short term that are genuinely destructive to a company's long-term health. The most famous of these is the stock buyback. A company uses its cash, sometimes cash it has borrowed, to buy its own shares on the open market. Fewer shares outstanding means each remaining share represents a larger slice of the company, so the price goes up. The CEO's compensation goes up, and the company's long-term investment capacity, the money it could have used for research, for raising wages, for new equipment, gets consumed in a financial engineering trick. Before 1982, stock buybacks were considered market manipulation and were largely illegal. After the SEC changed the rules in 1982, they became standard practice. American corporations now spend hundreds of billions of dollars on buybacks every single year. That is money that is not going into my paycheck or yours, and then there's the wage story. If my job as a CEO is to maximize short-term share price and labor is my biggest cost, then keeping wages as low as possible is not a moral failing. It is literally my job. It is what I was hired to do. It is what my compensation structure rewards me for doing. This is how you get a world where CEO pay went from 22 times the average worker's salary in 1973 to 271 times the average worker's salary in 2016. The mechanics are not mysterious once you see them. They are the predictable output of a specific philosophy applied consistently over 50 years. Let me make this real with one specific story that I keep coming back to: the Wausau Paper Company in Wisconsin, a paper mill that had been part of a Wisconsin community for over a century, employing local people, paying local wages. Embedded in the local economy the way that major employers used to be, the way I think most of us wish they still were. A hedge fund acquired a significant stake. The hedge fund did not want to be in the paper business for 100 more years. They wanted returns now. They pressured management to close mills, cut costs, and increase dividends. The factory closed. The jobs disappeared. The community that had built itself around that employer was devastated. The hedge fund investors got their returns, and the logic under which all of this happened was perfectly legal, perfectly accepted, and perfectly aligned with the Friedman philosophy. When I read about Wausau, I don't just see a business story, I see a town. I see people who did everything right and still lost, because the rules of the game changed around them without anyone asking their permission. Now I want to bring this into the present because everything I have told you so far is context for what is happening right now and what it means for you specifically. In 2020, something unexpected happened that I think you and I both remember. The pandemic shut everything down. The Federal Reserve flooded the system with money, and millions of people found themselves at home with stimulus checks, no sports to bet on, and a new generation of trading apps that made buying stocks as easy as ordering food on your phone. Robinhood eliminated trading commissions entirely. For the first time in history, people like you and me could buy a single share of a company with zero fees. The barrier to market participation essentially disappeared overnight, and then Reddit entered the chat. A community called Wall Street Bets noticed that hedge funds had taken enormous short positions against GameStop. Shorting means they were betting the stock would go down. If it went down enough, they would make enormous profits. Wall Street Bets decided to push back. Regular people, coordinating publicly on a message board, bought GameStop shares in massive volumes. The price exploded. The hedge funds, caught in what is called a short squeeze, had to buy shares to close their losing positions, which pushed the price further up, which made their losses worse, which forced more buying. Melvin Capital, one of the most exposed hedge funds, lost billions of dollars in days for a brief moment. People like you and me used the internet to beat Wall Street at its own game. It did not last. The volatility was extreme. Most people who bought at the top lost money, but the moment was real and its impact on how my generation thinks about markets is permanent. Now let's talk about where the market stands today, because the current landscape is unlike anything in this video so far. Remember the S&P 500, the index that is supposed to represent the broad health of American business? Something has happened to it that I find genuinely staggering. The Magnificent Seven, which is the informal name for Apple, Microsoft, Nvidia, Alphabet, Amazon, Meta, and Tesla, have grown so massive due to the artificial intelligence boom that these 7 companies alone represent over 30% of the entire S&P 500 by market capitalization. When you and I buy an S&P 500 index fund thinking we are diversifying broadly across American business, the single most important thing we are actually doing is buying Nvidia and Microsoft. That is not what most people think they are getting. The AI narrative, in Keynes's terms, is the most powerful market narrative of my lifetime so far. Whether the resulting valuations reflect underlying business reality, or whether we are watching another .com beauty contest play out in real time is the most important and most genuinely uncertain financial question I think about right now. There is also the matter of what happened when free money ended. For about 15 years following the 2008 financial crisis, interest rates were kept near zero. When borrowing is essentially free, companies can survive purely on narrative. They do not need profits, they just need a compelling story and access to cheap capital. The severe inflation of 2022 ended that era abruptly. The Federal Reserve raised interest rates faster than they had in 40 years. Suddenly, money cost something again. Companies that had been burning cash and promising future profits found that investors wanted profits now. The era of figure out the business model eventually was over, and the reckoning was painful for anyone who did not see it coming. I watched my own portfolio take hits during that period. That reminded me how important it is to understand what I actually own and why. And then there is one more chapter that I want to share with you. Remember how the historical part of this story ends with a question about whether shareholders could choose to invest based on long-term values rather than short-term greed. That question became a real movement called ESG investing, environmental, social, and governance. The idea is that you and I as investors should consider not just financial returns but a company's impact on the environment, its treatment of workers, and the ethics of how it is run. For a few years, ESG was the dominant institutional investing conversation, and then the political backlash came hard. Republican-led states passed legislation prohibiting their pension funds from considering ESG factors. The term itself became so politically charged that many fund managers stopped using it even when the underlying strategy remained the same. Where does that leave us? The core question that ESG tried to answer, whether people like you and me as shareholders can be a genuine force for long-term good, or whether the system will always default to short-term extraction, remains completely unresolved. More unresolved, honestly, than I think it has ever been. Here is what I want you to take away from everything we covered today. The stock market is not the economy. It is a measurement of what large investors believe profitable companies will be worth in the future. Those beliefs are shaped by narratives that can be wildly disconnected from economic reality. The Friedman philosophy turned corporations from community institutions into short-term profit machines. The buyback era transferred trillions of dollars from workers to shareholders, from my paycheck and yours to someone else's portfolio. The meme stock moment showed that when regular people act collectively, we can disrupt that system at least briefly. The AI boom showed that the narrative engine is still running at full speed, and the ESG backlash showed that the resistance to any alternative is fierce and organized. But here is what I genuinely believe and what I want to leave you with. Understanding this system does not mean you should opt out of it. Buffett's boring advice is still correct. Regular contributions to a low-cost S&P 500 index fund over a long-time horizon remains one of the most reliable wealth-building tools you and I have access to. The system is imperfect. It is rigged in some important ways, and it is still the most accessible path to building long-term wealth that most of us have. The difference is that now you and I both understand the engine. We know what is really being measured when CNBC tells us the market is up. We know who benefits most from buybacks. We know how CEO incentives got disconnected from worker outcomes. We know that the AI boom is partly a Keynes beauty contest and partly a genuine technological revolution, and that telling those two parts apart is one of the most important financial judgments of the next decade for both of us. Information is the only asymmetric advantage you and I actually have. Every dollar of institutional capital, every algorithmic trading system, every hedge fund with a PhD in mathematics is operating in the same market we are. The edge we have is knowing what most people around us do not know. Today, you added a significant piece to that edge, and so did I, because every time I make one of these videos, I find something that makes me think harder about my own money. Hit subscribe right now if you want to keep building that knowledge together. Every week on this channel, I break down exactly how money and markets and power actually work in plain language, without the filter. Share this video with one person in your life who thinks the stock market going up means everyone is doing better. That conversation matters, and it starts here. This is Dave. I will see you in the next one.